Every day we talk with folks that have the dream of home ownership, and they're looking to start that dream here in Fairbanks and North Pole. But after we get talking about how to make that dream come true, it comes out that there are a lot of misconceptions about how close most people actually are to making that dream come true. So we've got Bethanie Yoakum here with First Rate Financial to talk with us about how right now may be the best time to be a first-time home buyer. So thanks for joining us, Bethanie. There are a lot of misconceptions about, what it takes to be a first-time home buyer right now, and a lot of people are talking about why it doesn't make sense to buy a home right now. So let's get through some of these and talk about, the real truth in numbers that we've just talked about earlier.
Yeah, thank you. What I hear a lot from buyers when I began talking with them is they're very firm that they believe 20% down is what you need in order to obtain financing for a home. And while that used to be an old rule, and the rule around that is 20% down if you get a conventional loan, 20% down will allow you to not have to get what's called private mortgage insurance. And so 20% down payment is what we're referring to, but a down payment of 20% of the purchase price, right? So if you're looking at a $300,000 home, we're looking at a $60,000 down payment. A lot of people, especially nowadays, our country runs on credit. So a lot of people don't have liquid assets. And so $60,000 is not something that most people have in their savings account that is easily, like I said, easily accessible. And so a lot of people think that they're just like, okay, we're going to hunker down. We're going to sit in our rental that we have right now. We know that we can afford this payment. And so we're just going to hold off. We're going to save for the 20%. And I don't know if anybody has really sat down and done the math on that, but if you are looking to save, it's going to take, for this scenario, if you save $1,600 to $1,700 a month, it's going to take you 3 years to save $60,000. And that's just for the down payment. We're not talking appraisal, title fees, closing costs like homeowners insurance and taxes and all the other things that are a cost of getting a loan. So just the down payment alone is going to take you 3 years. And if you look at how houses have appreciated consistently throughout history, there's been one time in history where the housing prices declined, but eventually they went back up again. And we can show you a graph on that that's pulled from Fannie Mae directly. That alone, if you wait those 3 years, given the typical am I right on that, Justin, about 3 to 4% appreciation?
Pretty typically for Fairbanks, it has been about middle threes to fours. We spiked a bit as everyone kind of spiked,
right?
During COVID.
And that was what we would call like an outlier if you're looking at statistics. So I think we were around like that 19-20% during COVID, which again, an outlier. But if you're looking at the typical 3 to 4%, if you wait those 3 years, what you could have paid $300,000 for, and for that home, now you're going to pay about $337,000 for. So now your $60,000 is still not going to get you there. So you're kind of always playing catch up to get to that 20%, right? Where if you do the math, if you get a calculation of what estimated mortgage insurance, and it's just an estimate, but let's just say your mortgage insurance is about $120. Over 3 years, that $120, you're going to pay you're going to spend like $4,300 over those 3 years. So you're going to save $4,300 to cost you an additional $37,000. That math just doesn't make sense to me, right?
Mm-hmm.
If you look at how much your loan amount would be after 3 years of making your bare minimum monthly payment, not any extra, if you just make the bare minimum payment of your mortgage, you're already going to have a good chunk of that paid off. So let's just say the value of your home at that point after 3 years is $274,000. And then you have the equity, if it's worth $337,000, you're already gaining the equity. So you're already gaining grounds, right?
Right. So in that, you're talking about, the equity in appreciation of the market value of your home, and then the added value that you have in the equity and in ownership of your home, because you will have been making, all of your monthly payments.
Yeah.
So you've kind of got these two things happening, and all of this is your money.
Mm-hmm.
And while you're kind of waiting and building up that savings in order to put a down payment on, all of this is just going into somebody else's pocket.
Exactly. Someone else is getting it. Mm-hmm. Yeah. Oh, well, you're paying somebody else's mortgage because you're living in someone else's home that they own, and you're paying their mortgage from your rent. Yeah. Man,
that's a tough pill to swallow.
It definitely is. So, I mean, we always say, when's the best time to buy? Yesterday. When's the next best time to buy? Today. Because housing prices are always going to continue to go up because of appreciation. Rates are going to do what they do. Rates are going to fluctuate up and down constantly. You always have the option to refinance if the rates come down.
So in talking about home prices and rates, because they seem to be kind of like Clark Kent and Superman. You never see them in the same place at the same time.
Exactly.
Low rates and low home prices. Yeah. But we had looked at some historic, charts looking back at like the last 50, 60 years at home prices. Well, I guess longer than that for home prices and interest rates. And a lot of people have this, kind of in their mind that, home, or especially with interest rates, that they've never been higher than they are right now. And we just got to wait until the rates get a little bit lower. And that's what's going to change home affordability. But, looking at some of these charts, charting the interest rates going back historically, we're in a very low period historically for our interest rates. Can you talk a little bit about that?
Yeah, definitely. That's a good point. So there's a recency factor, right? So all of the first-time home buyers right now, the last time that the interest rates were above 4 or 5% was when everybody was in like junior high, so like 14 years ago, when the interest rates were in the 8%, I was focusing on playing sports and doing all these things and being a kid. I wasn't focusing on the economy and what mortgage interest rates were. Like my parents never talked to me about those kinds of things. So
what's Justin Timberlake doing right now?
Exactly. That's funny. I just listened to Backstreet Boys on the way to work this morning. Me and my kids are rocking it out. And so, like, just to touch base on that recency factor, everybody that's looking, if you're a first-time home buyer right now, those rates you've only ever heard 4 or 5%. So yeah, it's very understandable that 7-8%, and I think we're diving out of the 8% right now. I haven't seen 8% for a while, but very much like the 6s and the 7s right now, depending on your specific scenario and your loan type that you are qualified for. But even the 6 and 7% are sometimes a hard pill to swallow, given affordability, given inflation in general, with everything. But if you look at what's important is when you're obtaining a home loan is you're not just getting a home loan. It's so important that you are speaking with somebody who is looking at your financial picture as a whole, right? They're not just like a waitress and order taker saying, yep, you're approved, go ahead, go look for a home. Here's my lowest rate, whatever. But they're looking at, like I said, your entire scenario all together. If you want to get a home, but you have, let's say you want to get qualified for that $300,000 home, but maybe they tell you no. Maybe they say your debt to income ratio is too high right now. Maybe they didn't look at the fact that you could, if you paid this debt off, right? If you lowered your monthly debt, your credit card debt in the country is the highest it's ever been historically. We're in the trillions right now. America lives off of credit. And so if you focused on paying that down versus the crazy interest rate that the media is forcing you to focus on, right? And you lower your overall monthly financial obligation, that affordability becomes a lot more possible.
For sure.
Yeah.
Absolutely.
Yeah. And those rates, and your parents, when they first bought the home in the 80s, I think they peaked at like 18 or 19%, And so historically, we're not that crazy and far off.
Thinking about moving to Fairbanks? Well, click on the link below for my free relocation guide where I talk about top schools, top neighborhoods, and so much more.
And the other thing that ends up happening too, when these rates do drop, and when the rates dropped last time, when we saw that huge drop in 2020, we saw our inventory drop pretty dramatically too, and it still hasn't recovered. I mean, it hasn't recovered since like 2008, but when that happened, our inventory was not great, but it took it down to an even lower point, which took our home prices up pretty dramatically. So we can even, if you have those graphs that we can put up, or we can share.
Yeah, I'll pull those up. So home prices. So here's home prices. Let me share my screen. So home prices from 63, and again, this is straight through, Fannie Mae's HUD's website, actually, Fannie and Freddie Mac. You can see that home prices have continued to appreciate. This was the spike here in like 2023, like last year. Mm-hmm. And then they've dipped down just a little bit, but they'll come back. But you can see again where they dipped down in about 2008. That's when the market crashed. Mm-hmm. When they dipped back down. This is because this was like basic supply and demand. This is when you had too few people chasing too many goods. We had too many homes in the market. And so it drove the prices down and nobody was buying. Here is where we had too few goods and too many people chasing too few goods, which caused the price to go way up. Interest rates. This is the interest rates that we've seen, again, pulled through from Freddie Mac's website, third-party source. You could see the spike right here in the mid-80s. And that they historically come down. You can see the volatility. Like these are all ups and downs, ups and downs. This is what a market does. But inflation and all of these things have come down. And then you have here where, like right here, is where they've kind of stayed pretty steady. Like, they're down and here, but they're, it's a little volatility, but it's fairly flat if you were to draw, a line. Here is COVID. This is when the market went like, 20 is when COVID happened, right? And just kept going down. There's a lot going on here with the Federal Reserve, and what they did was called quantitative easing, trying to keep the mortgage rates artificially low. And then when they quit doing that, that's when we saw this huge spike in interest rates here. So that's when you saw rates in 1 year go from 3.5% to that 7% to the 8%. And they've been fighting it ever since.
Trying to keep our inflation at bay as much as possible.
Exactly. Yeah.
So, based off of those two graphs, it seems like if we're waiting for our interest rates to drop in order to, maybe then we'll be ready to buy, because then homes will be more affordable. Well, not only will we be, if we're doing all of these things, we're saving for 20%, we're waiting for interest rates to drop, and waiting for homes to be more affordable. Homes are not going to be more affordable. Even if interest rates drop, the rate or the prices are going to be up. So you're going to be paying less interest, I guess, but on more money, or on more of a purchase price for the home. And if you're saving 20%, that just doesn't seem like it's a very viable or feasible, realistic thing to be doing.
Yeah, it might be for you, but it may not be the best option, right? It's just important to figure out what is the best thing for you to do right now, for you and your family, given your specific situation right now. Waiting isn't always the best game. So
what are some documents that we need to bring with us if we want to schedule one of those?
Oh, totally. That's a great question. So your last 2 years of W-2s, most recent 2 years, your most recent 30 days of pay stubs. If you're self-employed, I'll need your most recent 2 years of tax returns and most recent bank statement. And hopefully you bring your driver's license with you, because you would have driven here. And that's about it. There might be more documents down the road, but that's the basic upfront stuff that we need to get things started.
All right, so we talked about a lot of things today. Essentially, why right now might be the best time to be a first-time home buyer. Home prices are going to continue to go up, as historically they have gone up forever and ever and ever. So tomorrow, home prices are just going to get more expensive. Interest rates are going to be all over the map, but they've been kind of in the ballpark of where they're at right now for decades. So if we're waiting, it may not get better than it is right now. So the only time to get in that may have been better was yesterday. So unless you did it then, may as well start today. If you'd like to get a hold of Bethany, we've got her information down in the comments section or down in the description below. And you can always do that. You can always reach out to her or us on our website as well, www.fbxhomesearch.com. You can also give us a call, 907-885-0316. Thank you so much and have a great day.